Hey everyone, today we're going to talk about option spreading and particularly with a strategy that I've been using with great success recently in the TLT, which is the bond ETF. Okay, so first of all, I know that a lot of you are familiar with buying puts and buying calls. A put or a call is simply almost like a real estate option. You buy the option to buy a property, or in this case, 100 shares of stock at a certain price for a certain time. The difference being, of course, is that options are very much more liquid and they can be bought and sold long before the expiry. So that's the basic, and I'm sure most of you are familiar with it. That's basically how options works. Now, I know that there's a reluctance to get into spreading options because it's the next step. However, the next step is important, and I want to tell you why. Well, I'll tell you right now. The biggest reason is that 80% of options expire worthless. Okay, so the floor traders are always short the options. They're always short. Now they'll hedge with the stock or whatever, but they're short because they're going to win 80% of the time just by holding the position. Okay, most options expire worthless, so that's a steep hill to climb. So what you want to do in option spreading is start to take advantage of some of that 80% win factor and turn it in your favor instead of always paying it away and trying to be in the 20% the time that you're going to make money, or that it's not going to expire worthless. Let me put it that way. All right, so option spreading offers a few advantages. One is better risk control because we're long something and we're short something. So you're making money on one side or the other. So that smooths out your equity curve. You can raise your percentage of wins for sure. And it's substantially more flexibility. And I'll show you what I mean by flexibility as we go here. Um, we won't take too long on this, but you need to know, honestly, if you're going to trade options, how to use time decay to your advantage instead of paying it away. You need to understand how the floor trader works and use that same mentality to your advantage. Okay, so here's how options time decay expires. We all know that if an option is worth $5 uh, and it takes a month to expiry, in a week it's going to be worth 350, and in another week after that it's going to be worth 250, and so on down the road. But as you can see, the further you go out, if I have an option that's 6 months out or 8 months out, say after 5 months, or sorry, if I have an option that goes 8 months out, after 1 month and it's only got 7 months left, this is my decay here. This is the very part of that curve. So that option decay hasn't been very much. Where the option decay starts, as you can see, is we get closer and closer to expiry. So this is why we want to be long far out and short in the short dating. Now, another way to look at this is to look at it in terms of a covered right. Now, on a covered right, you probably have heard this expression: you own the stock and then you sell the right to buy it at a future date. So you buy 100 shares of XYZ company at $100. You sell a 105 call for $2. You receive the $2 premium no matter what. If the stock goes up to 105, somebody will buy it off you. So you collect the $5 profit plus the $2 you wrote. So you make a 7% return. Okay. So what we are doing in option spreading is essentially the long dated option takes the place of the stock in the option spread strategy. Okay, so you own the far dated and you sell the near dated against it. Okay, so that goes back to our previous chart where we want to be long up here where time decay is small and short down here where time decay is higher. Okay, I'm going to give you an example of a calendar spread here. You buy it, let's say in October at $5, and you sell a September at $2. So our cost is we paid for 5, we received 2, our net cost is 3. Okay, so it can be the same strike or a different strike, but it's a different expiry. You want to be long on the far dated call and short on the short dated call. Now, let's say that short dated call here in our example, let's say that this 200 call, the market doesn't get to 400, so it expires worthless. then you have another chance to sell, you know, a September 30th or an October 3rd or whatever, against that long call again. So you've collected this $2. Now you've got a chance to collect another $2 or a dollar or whatever you choose to sell at. Okay, so it gives you multiple chances to reduce your initial cost. Okay, that's how time works for us. Now, of course, if it goes up, because the decay on this $2 is going to happen at a faster rate than the $5, the spread is going to be more than $3 by expiry. Okay, so it's a win-win. What the risk is that the market goes thundering lower, and the $2 you make on this call doesn't offset what you lose on this call. Okay, so that is the risk. But I'm going to show you particular strategy that we're using right now, where that risk is almost nothing's ever totally mitigated, but it's very largely mitigated. Okay, so here's an example of what we're using right now, as I'm going to show you in a minute. This time we're buying that call at $5, but we're selling a higher strike call. So this is a 400, this is a 500, and we're only getting 75 cents. Okay, so you can change up your strike prices. Again, this October 31st here that I've written is like owning the stock. So once you own the stock, you can choose what call you want to rate against it, and that's all we've done here. Okay, so let me give you an example of what we're doing right now, and that's been very successful and is being very successful for us, and I think will be successful as a strategy well into 2025. So what we're using is the TLT, which is the bond ETF. It's extremely liquid, very tight spreads on the prices for options. Okay, so that's a great thing. Now, what do we know about bonds and interest rates right now? Well, we know that almost certainly they're not going higher. Okay, nothing is 100% certain, but I think we all agree that there's a very, very, very high probability that interest rates are not going higher. So what does that do? That gives a natural floor to the TLT, gives a natural floor to bond prices. Okay, so for instance, if I think crude oil is at $70 is cheap right now, it doesn't matter. Mean it can't go to 10 just because I think it's cheap. And in fact, we've seen it at 10, not that long ago even. So, but bonds are different because we kind of know interest rates aren't going up. At least there's a very, very, very small probability they are going up, so we have a natural floor. The options there are very liquid. So what do? Well, we buy during little bouts of weakness. We buy those long dated, which is essentially buying the stock. And then during rallies, we short the short dated calls. Remember, because that's where our maximum time erosion is. That will make us money. So let me give you an example of what we've actually done here. And this was a trade that recently done, and I've got many positions like this because this is one of those opportunities where it is a high probability and a great risk reward. Usually risk reward and probability are teeter-totter. So when you find one that offers you both, you start hitting on it. And that's what we've done here. So some time ago, we bought the March 96 calls at $2.90. Now, March 2025. Okay, so this is a current example. And we started this trade back in probably June. Okay, so as the market rallied, what I did is I sold like the 99s, and then I sold the 99s again because the first ones expired. So I sold them for 70 cents. The 90 cents, they expired. Oh, then I sold a 98 and a half for 75 cents. And finally, I sold a 98 and a half again for $1. So what have I done? These all add up here. That's $1.60. That's 245. That's 345. So I have gained more selling options than I paid for the original option. Okay. Now, if we look at where TLT is right now, it's over 100. Okay. So this option here has an intrinsic value of almost $5, and it's still got 6 months till expiry. Okay. So you can see what a great strategy this is. And this is why I've got 4 positions in various expiries. I had one that started in October. We just took it off for about 120% gain. And so I've also got January 96 calls, I've got March 96 calls, and I've got June 96. Um, on the next dip, I'm going to start to go out to September and maybe even January of 2026, and we use the same strategy. Uh, when bonds dip, I know there's a natural floor, and when they rally, I'll start selling out of the money options against them for the 70 cents, 90 cents, 25 cents, a dollar. Okay, they're not the far dated options are not quite as cheap as they were when I bought these for 290, which made them even a better deal. But they're more like $4 now, so you can. It's still going to be a great strategy, and it's one we're going to use going forth in 2025. Again, high risk, or sorry, low risk, because of the natural floor, unless interest rates start to rise, and it takes advantage of that time decay in options that we pointed out. That's always occurring in the short dated, and it gives us that 80% advantage that options expire worthless to our advantage instead of paying it away. Okay, so that's my strategy on TLT and on spreads. If you're not in spreads, if you don't understand spreads, I hope this clarified it, because you're really missing great opportunities if you're just sticking to straight puts and calls. Thank you for listening, uh, and I'll talk to you soon.